This is Nightly Business Report with Bill Griffith and Sue Herrera.
Economic puzzle. Americans are earning more money, but they're not spending it. And some economists are trying to figure out why. Change of plans. Amazon's big push to expand may not be as clear-cut as it once seemed. Sideways drift. If you think the rally is about to slow, our market monitor has some stocks he says are winners no matter what. Those stories and more tonight on Nightly Business Report for this Friday, March 1st. Good evening, everyone, and welcome. Bill Griffith is off tonight. March is coming in with a roar. It wasn't a huge rise today, but enough to keep the mood upbeat. The S&P 500 closed above a key psychological level for the first time in months. Today's action extends the best two-month start to a year for the Dow since 1987. The blue-chip Dow index rose 110 points to 26,026. The Nasdaq added 62, and the S&P 500 was up 19, closing above 2,800. The Dow snapped 9 straight weeks of gains, while the Nasdaq rose for its 10th consecutive week. Investors spent much of the day trying to make heads or tails out of the latest economic reports, which showed something you don't often see. Steve Leisman explains.
History shows when Americans have more money in their pockets, they tend to spend it. And a report issued Friday, which had been delayed by the government shutdown, showed that incomes in December surged a healthy 1%. Good news right in the heart of the holiday shopping season. Wages were up a strong 0.5%, which should have sent Americans to the mall with some spending abandoned. But they didn't go, at least not according to the latest data. Consumer spending fell by 0.5 point, the worst December decline since the financial crisis. With earnings outstripping savings by a wide margin, the savings rate shot up, hitting 7.6% of disposable income, the most in almost 3 years. Did Americans suddenly turn frugal? Unlikely. Economists point to a series of one-off factors that boosted income, including farm subsidies from the trade battle and a one-time special multi-billion-dollar dividend paid by VMware. And there's skepticism, too, that consumer spending was really that bad.
The government was under partial shutdown, so we don't know if that has messed up numbers. We're either going to see those retail sales numbers revised and an even stronger fourth quarter, or they're going to get measured in January.
It's been a good rule of thumb. When Americans have more money in their pockets, they spend more. December was probably an exception to that rule, not a repeal. For Nightly Business Report, I'm Steve Leisman.
Auto sales had once been hot, and all of that spending was an important part of economic activity. But it appears as if demand may be stalling out. February sales dropped compared to the same time last year. It wasn't a huge decline, but enough to have automakers and dealers asking if sales of new cars and trucks is cooling off. Here's Phil LeBeau.
Americans appear to be tapping the brakes when it comes to buying new cars and trucks. February sales slowed down compared to the same time a year ago, with Nissan, Toyota, and Fiat Chrysler all reporting lower sales. Overall, demand for new cars and trucks is still relatively solid, largely because of several key factors. For starters, consumer confidence remains high, and the country continues to add jobs at a healthy clip. Mix in cheap gas with the surging stock market, and you see why many Americans are still comfortable buying a new car or truck. Will auto sales top 17 million vehicles for a 5th straight year? Well, it's too early to tell, since January and February are low-volume months. Spring is when auto sales traditionally kick into a higher gear. So within the next several weeks, we should have a pretty good idea if automakers and auto dealers are expecting another year of solid sales. Phil LeBeau, Nightly Business Report, Chicago.
We also learned today that the manufacturing sector grew at a slower pace in February. According to the Institute for Supply Management, new orders, production, and employment all slipped. And it was that weak data that caught the attention of the energy market, creating concerns over the potential for weakening global demand for oil. And that sent the price of domestic crude lower by 2%. Optimism over trade with China also helped give stocks a lift today. This after a Bloomberg report stated that U.S. officials are getting a final agreement ready for President Trump and Chinese President Xi to sign a bit later this month. Eunice Yoon is in Beijing tonight.
March 1st tariff deadline is delayed, and President Trump and his administration are sounding largely bullish that a trade deal can be done. At his press conference Thursday in Vietnam, President Trump said the U.S. and China negotiators were on their way to doing something special. White House economic advisor Larry Kudlow told CNBC that the two sides were on the verge of an historic deal, and Treasury Secretary Steven Mnuchin said the document is 150 pages and very detailed. The buzz is that the U.S. side is hoping to have the agreement ready so that President Trump and President Xi can sit down for a summit as early as mid-March. Between now and any Trump-Xi summit, President Xi will be preoccupied with a major Chinese political event called the National People's Congress. Huawei's CFO is currently scheduled to have her extradition hearing next week. President Trump has hinted that he could include Huawei in the trade deal. At the same time, President Trump said in Hanoi that he could walk away from any deal, including one with the Chinese. No official comment from China on his remarks. For Nightly Business Report, I'm Eunice Yoon in Beijing.
Eunice just mentioned that extradition hearing of Huawei's CFO. Well, today, Canada said the U.S. has presented enough evidence to proceed with that hearing. U.S. prosecutors have accused the executive of violating U.S. sanctions on Iran. According to Reuters, China says it is, quote, utterly dissatisfied with and firmly opposes Canada's decision to allow the Huawei extradition case to proceed. The next budget battle to rattle investors is fast approaching, and that is debate over the debt ceiling. The Treasury will begin using extraordinary measures to pay its debts, buying time for Congress to act. Elon Mui has more from Washington.
The national debt stands at $22 trillion, and starting tomorrow, the Treasury Department can't borrow any more to pay the nation's bills. That's because the debt limit comes back into force after Congress suspended it 2 years ago. They'll have to act again or risk defaulting on our debt. No one knows exactly when Treasury will run out of cash. The CBO projects it could happen late this fiscal year or early in the next one. In a letter to Congress, Treasury Secretary Steven Mnuchin said, honoring the full faith and credit of the United States is a critical commitment, and he urged Congress to raise the debt limit. But those negotiations have yet to begin in earnest on Capitol Hill.
I think on a bipartisan level, we should sit down together and find a way that we can stop the spending behavior of this government and actually curve to where we could pay off our debt.
To make things even more complicated, the deadline for the debt ceiling is smack in the middle of two other big fiscal fights: the deadline to fund the government and prevent another shutdown, and the deadline for avoiding automatic spending cuts that would chop $125 billion out of the federal budget.
Unless we get a budget deal, sequestration returns in fiscal year 2020. That would mean steep cuts in programs that invest in America and support working families.
For now, the clock is ticking. For Nightly Business Report, I'm Elon Mui in Washington.
It is time to take a look at some of today's upgrades and downgrades. American Airlines and Delta were downgraded to hold from buy at Deutsche Bank. The analyst cites global economic headwinds. The price target for American is $40 and $55 for Delta. American fell more than 2.5%. Delta was down more than 1%. Hertz was upgraded to equal weight from underweight at Barclays. The analyst cites strength in rental car prices. The price target is $18. The stock closed just above that level to $19.35. A number of brokerages increased their price targets on the Gap, including the Telsey Advisory Group, which has a $40 target on that stock. This follows the decision by the Gap to split the company and separate out Old Navy, something we told you about yesterday. Telsey rates the stock and outperform. The shares rose 16% to $29.51. So, will Gap's decision to separate from its better-performing businesses become a trendsetter for the other companies to follow suit on Wall Street? Joining us to talk about that is Mike Bailey, Director of Research with FBB Capital Partners. Welcome, Mike. Nice to have you here.
Great. Thanks for having me back.
You make the point that when you split up the businesses, the two companies, or in this case, several companies, can really focus on their separate businesses, both the pluses and the minuses?
Absolutely. I think that's a really good thing about spin-offs. So you may have one company with a bunch of different businesses kind of thrown together, and the companies figure out that it sometimes can be kind of a mess, and they say, let's just split these up, let's focus. I think in some ways that helps in terms of the management's time, so the new CEOs can really focus and get their projects done. Additionally, you think about money. So if you've got a big umbrella and a bunch of companies there, you've only got so much money to sprinkle around. So if you got that separated, you can do that in perhaps a better way, a little bit more smartly. So in general, there's a couple things that we do think that helps as companies tend to break up. So
do you think this will become a trend on Wall Street? And if so, are there companies that you think are likely candidates?
Sure. So, in terms of thinking about spinoffs, these things, we see spinoffs all the time. Sometimes they'll be more in the headlines, sometimes they'll go away for a little while. We're hearing a little bit more about spinoffs these days, but I don't know if I would call it, a major trend. We see tons of massive, sort of the opposite of spinoffs. We see, mergers happening all the time. Bristol Myers is buying Celgene for, $80 billion. So we're seeing both sides of it. Spinoffs, they'll likely continue. It's tough to say if you're going to see a big wave of them. One particular factor that could lead to more spinoffs, if you broaden the spectrum a little bit, if you look at interest rates, if interest rates were to move up a lot, that would make it really expensive for companies to do big merger deals, and that might slow the mergers down, and you might see more spinoffs afterwards. So there's a few things happening, but we'll probably see a few more spinoffs, but we don't expect a massive wave coming.
Or does it pertain more to areas that are struggling? For instance, we know that the Gap was struggling for a while. It's in the retail sector. Retail is tough right now. Is that type of atmosphere when a company is struggling in a difficult niche, is that when you tend to see more spinoffs, or does it not apply?
They're all over the map. So you can see sometimes, a company where basically the entire business is challenged. And if you look at Gap, you've got, half the business, sort of the Gap and Banana Republic's definitely struggling. Old Navy's doing a bit better. So you've got kind of a mix there. I think some of the best spinoffs we've seen are where you've got sort of maybe an older, mature business that's doing fine, it's doing okay, and they've got a really great, exciting asset that's just really buried. And they want to release that and sort of let that, go off on its own. I don't think we're really seeing that in the case of Gap. So that's something we currently don't own the stock. There are other apparel companies we prefer as opposed to it. Okay. So I think it is going to have some challenges.
Mike, thank you so much.
Thank you.
Mike Bailey with FBB Capital Partners. Still ahead, speaking of splitting up, that same theme extends to Amazon.
It is a drama worthy of an Amazon Prime Video. New York, jilted by Amazon, tries to win the company back as its marriage to Virginia is on the rocks. Meantime, Amazon's own expansion plans are a mystery. I'm Scott Cohn. We'll have the story coming up on Nightly Business Report.
The grocery industry got a bit of a surprise today. Amazon is reportedly making a big push into that business with plans to open a dozen food stores in several cities. And you can see when the news crossed midday, Kroger's shares fell sharply. Deirdre Bosa has more on what Amazon may be considering.
Amazon may be getting deeper into the grocery business, a nearly $650 billion market in the U.S. According to the Wall Street Journal, the e-commerce giant is planning to launch a new chain of grocery stores, adding to its portfolio of Whole Foods, cashierless convenience stores, and Prime Now delivery grocery offerings. The report says that Amazon is planning dozens of these new stores across the country, and the first one will open in Los Angeles as early as the end of 2019. Amazon has been experimenting with online groceries for over a decade. Its 2017 purchase of Whole Foods was a major step into the brick and mortar format, and it has further expanded its physical footprint with Amazon Go, its cashierless concept that now has 10 locations. Amazon declined to comment on the report, but shares of food retailers like Sprouts Farmers Market, Kroger, Target, and Walmart, they all moved lower on the news and the threat of Amazon pushing further onto their territories. Whole Foods' pricey reputation has led to the nickname Whole Paycheck. Amazon has been lowering prices and offering discounts to Prime members, but some customers say that it hasn't been enough. The report says that the new stores are not designed to compete directly with Whole Foods, and they offer a wider variety of products. For Nightly Business Report, Deirdre Boza, San Francisco.
And when it comes to Amazon, New York isn't giving up on its second headquarters project, despite the company's decision 2 weeks ago that it is pulling out of a deal in Queens. Meanwhile, protests are growing in Arlington, Virginia, home to another part of the project. In the balance is Amazon's critical expansion plans, which no longer appear as clear-cut as they once seemed. Scott Cohn reports from a key Amazon facility in Silicon Valley.
Amazon needs to grow, and it needs people. For now, they're spread across 17 key locations across the country, like this research campus where they develop new devices. HQ2 was supposed to let Amazon expand its footprint in a big way.
This is the largest economic development initiative that has ever been done by the city or the state.
It hasn't worked out that way. First, Amazon had to split the project between New York and Virginia. No one location had enough workers. Then protests in New York over incentives and housing. Amazon pulled out, emboldening activists in Virginia.
David hit Goliath, and Goliath ran out of New York, and so down here, we might be David or a lot of little Davids, and we think we've got a chance.
Now, New York sees an opening to win Amazon back. Governor Cuomo says he's spoken to Jeff Bezos personally, and dozens of community leaders have signed on to an open letter in the New York Times. Sure, opinions are strong in New York, sometimes strident. We consider it part of the New York charm.
The fundamental reasons why Amazon wanted to be here remain the same, right? It's a spectacular opportunity to build a world-class headquarters on a fantastic neighborhood.
Meanwhile, Virginia is doing its own damage control with Amazon.
We're going to find that magic space where our interests align with their values, with their potential path for growth.
There is no sign that any of this is changing Amazon's mind. For now, the company plans to put those 25,000 workers who were going to New York in its existing facilities like this one. But that in itself marks a major scaling back of a project that once held an entire continent transfixed. For Nightly Business Report, Scott Cohn, Sunnyvale, California.
Walgreens shares caught a chill, and that's where we begin tonight's market focus. The Dow component said its outlook is being clouded by drug reimbursement headwinds, as well as pressure from lower prices for generic medicines. But one analyst said he's encouraged by management's move to cut costs. Nonetheless, the stock fell more than 6% to 66.61, making it the worst performing stock in the Dow today. Customers spent more on sneakers at Foot Locker, helping that company report strong sales in its most recent quarter. The retailer easily topped Wall Street's earnings estimates and said it's looking to further improve its margins. It also plans to close 165 stores this year. The shares sprinted ahead, up about 6% to 63.07. Tribune Media's results beat expectations, helped by strong advertising revenue during election season and higher carriage fees. Tribune is getting ready to be acquired by broadcasting giant Nexstar Media Group for more than $4 billion. Shares rose slightly to 46.42. Masco said it will explore strategic alternatives for its cabinetry and window businesses. The businesses include well-known brands like KraftMaid and Marilat. The home improvement company says it plans to complete the review by the end of June. Masco was up 6.5% to $40 a share. And Puma Biotech beat earnings and revenue estimates. The drug company also issued better than expected full-year guidance. The strong results were helped by sales of its breast cancer drug, which were up more than 200% since last year. The shares rose nearly 40% to finish at $38.93. And it's time now for our weekly market monitor, who likes companies he says should hold up if we get a pullback or even a sideways stock market. Joining us is Bill Stone, Chief Investment Officer with Avalon Advisors. Good to see you again, Bill. Welcome back.
Thank you.
Let's start with your first pick, Walt Disney Companies. I have to say, I was there last week. The parks definitely have pricing power, and they were really, really crowded.
So you really played into it. So the themes are really, one is people really are valuing experiences over goods. So that's it, right? Going to the parks. The second one, which I don't think people think about as much, is really the cord cutting idea. So Disney has the content to go direct to the consumer over the long run. I think that's where things go. So obviously everyone thinks about the Disney movies, etc., but also think about ABC, think about ESPN. They're also in the process of acquiring some of those properties from 21st Century Fox. So they are going to be in a position to really offer that direct.
And they offer a dividend as well.
Yeah, I mean, so I think it's a really interesting, there's some worries about that acquisition, so I think it's a really interesting piece going forward.
Okay, Eli Lilly, they spun off their animal health business, but you say they have a diversified set of drugs and very strong ones as well.
Yeah, so I mean, obviously, and again, another theme, we know that, the graying of America, frankly, the graying of the globe, there is, it's a guarantee we're going to have more demand for drugs. The other good thing to know about Eli Lilly is they have very little patent expirations coming up here soon. The second part is even some of their drugs, when they come up to patent, are very difficult to take generic because the insulins are very hard to recreate. Mm-hmm. The last piece is they have a very good pipeline. Particularly, they have a couple cancer drugs. Again, they have to get through the testing and get through the FDA. But if they do, there's some real blockbuster upside to those.
Now, the last pick is ExxonMobil, and it's been an underperformer if you value it against the S&P for some time now. Why do you like that stock?
Yeah, so I think one thing is that energy as a whole has just been a dog for years. So what has changed, right? And I think what has really changed is, particularly for an ExxonMobil, and I'll talk about them in particular, they've changed their business to be able to make more money at a lower oil price. They've also focused more on actually making money rather than just producing oil. And that obviously as a shareholder means a lot. Lastly, that also means that they can pay a very large dividend. So you're talking a more than 4%, like a 4.2% dividend yield, which I think will continue to grow over time.
Bill Stone, thank you so much. Bill is with Avalon Advisors. To read more about his picks, head to our website, nbr.com. Coming up, the space race is ready for liftoff.
From Launchpad 39A at the Kennedy Space Center, I'm Morgan Brennan. It is a key test launch for SpaceX, but also for America. We've got that story coming up, Nightly Business Report.
Here's a look at what to watch for next week. On Tuesday, China's National People's Congress gets underway. Investors will be looking for any economic policy changes. On Wednesday, Target reports earnings, which will provide a fresh look into the state of retail and the health of the consumer. And on Friday, the government releases its monthly employment report. And that's what to watch for next week. Wells Fargo officials have reached a record settlement with shareholders over the bank's fake account scandal. The deal requires insurers for current and former executives to pay $240 million to the bank. It resolves claims that executives breached their fiduciary duties by failing to stop the creation of the bogus accounts, which were made without customer authorization. The officials denied any wrongdoing. The ride-hailing company Lyft has filed to go public. The firm is looking to raise as much as $100 million in its initial public offering, though that amount could be changed based on investor demand. It will list on the NASDAQ under the ticker symbol LYFT. In the filing, Lyft reported that it lost more than $900 million last year on more than $2 billion in revenue. Lyft's IPO is expected to be among the first of a wave of public offerings this year. And finally tonight, a story that is literally out of this world. SpaceX is readying for a launch that could usher in a new era of space exploration. Morgan Brennan is at the Kennedy Space Center in Florida.
It's a critical test that would mark a major milestone for commercial spaceflight and for America. SpaceX's Demo 1 launch for NASA. If all goes as planned, it will be the first time a commercially built spacecraft designed to carry humans will launch into space and visit the International Space Station, and do so for the government.
We're doing things that are really risky that most normal human beings don't do. and the designs and the complexity of what we have to do. We're strapping human beings on top of rockets with millions of pounds of thrust and hurling them into orbit to go attach to a space station to do world-cutting research, and that isn't trivial.
The last time astronauts launched from American soil was from this very same launch pad, 39A, in 2011. Since the space shuttle program ended, the U.S. has not had the capability to send humans into orbit. Instead, we have paid large sums to the Russians to do it for us. To address that, NASA awarded 2 contracts, one to SpaceX to develop the Crew Dragon capsule for about $2.5 billion, the other to Boeing for just over $4 billion for its CST-100 Starliner. SpaceX and Boeing own and operate the capsules, and NASA will lease them for missions. It's a different business model than the past, and one that speaks to how crucial the private sector has become in this new space race.
Human spaceflight is basically the core mission of SpaceX, so we are really excited to do this. There's nothing more important for us than this endeavor, and we really appreciate the opportunity from NASA to actually do this and have a chance to fly up to the station.
This mission won't have people on board, but SpaceX is the first to get this far in the testing process. Boeing is expected to do its unmanned flight next month. It all means the spacecraft could be carrying astronauts as soon as this summer. But first, things need to go right tonight. SpaceX will launch its capsule with a Falcon 9 rocket as it begins a week-long journey to the space station and back. For Nightly Business Report, I'm Morgan Brennan at the Kennedy Space Center in Florida.
Here's a look at the numbers on Wall Street. At the close, the Dow rose 110 points. The Nasdaq added 62. S&P 500 was up 19. The Dow snapped 9 straight weeks of gains, while the Nasdaq rose for its 10th consecutive week. And that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us. Have a great weekend. We'll see you Monday.